question that I have, and Brad, maybe there's a smart analyst on your team that can do it and it's more of a statement as well. Can you imagine the totality of stock-based comp that's been given out by all these companies since 2015 when they were CAGRing their employee bases by 25% a year? I bet you it's $1.5 trillion at least. You think it's that? You think it's in that order of magnitude?
100%. This has been the greatest grift in the history of Silicon Valley, for sure.
Let's pause for a second. Can you explain what we're talking about here? Stock-based compensation, obviously, is the stock given to employees. It's generally not counted
let's do it,
in the accounting, right?
Let's do it this way. Let's just say that you believe in capitalism, okay?
Yep.
So if you believe in capitalism, let's say the four of us start a company and there's $1 of profit and we each own 25% of the company.
Got it.
Normally, what you would say is each of us get 25 cents, right?
Reasonable.
We own 25% each. There's $1 of profit. We each have 20. So that means that in 4 years, right, we each will have made $1. Because let's just say it costs $1 to get off the ground or $4 to get off the ground.
All in Summit budget.
We all would have been made whole. We all would feel great. And then now every year afterwards, that 25 cents we get is profit. Now let's say that, Jason, you add a fifth person. And Brad and David and I can't say anything about it.
Okay.
And that fifth person now gets a fifth of it, right? And so now all of a sudden, our 25 cents goes down to 20 cents. Then let's say you add 5 more people. Now all of a sudden, our 25 cents went to 20. And then it went to
10 cents.
10.
Yeah.
And at some point, Brad and David and I raise our hand and say, hey, this is not the deal we signed up for. And you say, well, too bad, because revenue would not be what it is and profits would not be what it is without these extra 6 people. And that's effectively what everybody debates when they own a stock. The shareholders want that number to be as small as possible. And I think what Brad is observing is that in Silicon Valley, what has happened is there's been poor accountability for what all of those extra people do. And profits haven't risen fast enough to make the existing 3 people on the cap table feel okay about it. And that, instead of talking about 3 people and 6 and $1, you're talking about trillions of dollars and hundreds of thousands of extra shareholders.
Brad,
millions of extra shareholders.
I know we have some charts here so we can do some fun with numbers.
I think taking a step back, I think it's very important to realize that stock as a form of compensation to create alignment, excitement in the early stage of venture capital is part of the true magic of Silicon Valley. You know, you're starting a company, you ask somebody to go on this adventure, take a bunch of risk. They often have to cut their pay. They could get at Google by half to join your adventure. It's only fair that you give them stock in the company and they share in the ups. And if the company smokes it, they get rich for taking that incremental risk on their behalf and on their family's behalf. What's happened over the last 15 years is something totally different, which is this stock as a form of early stage compensation, right, continued. And there's a feature in Silicon Valley as companies came public. One way to kind of hide an expense in a business is to bury it in SBC. So let's say Google wanted to hire somebody for $4 million, which they're doing today in AI. But instead of paying them $4 million in cash, which would all count against their operating profit, they give them $500,000 in cash and $3.5 million in stock. And let's say they make all that stock vestable immediately, Jason, in this year. It's obvious to you and I, that's just cash. The person turns around and sells it. It's a real expense of the business, real expense to the shareholders. But when they report their earnings and they report adjusted EBITDA, they adjust out the $3.5 million that they gave by way of SBC.
Why did stock-based comp, SBC, get excluded from accounting? What is the history of that? And is that going to change now? Are people going to say, and shareholders demand in this new economy, in this new, sort of reality, hey, you know what? You can't play fun with numbers here. Stock-based comp has to come out. What would you like to see, Brad?
It's fairly esoteric, but back in the mid-2000s, 2004, 2005, there was a big debate about this. Warren Buffett was famously saying, listen, it doesn't matter whether you pay in stock, whether you pay in cash, whether you pay in cans of beers, like it all costs the same.
He's right.
And so there was a debate. We had a statement, an accounting statement, FASB 123. And in that statement, it said GAAP EBITDA must include the cost of stock-based compensation. So all of a sudden, if I'm reporting GAAP EBITDA, I got to include the cost of stock comp, which it does today. But what did everybody do?
But what happened?
They started adjusting it out, right? Because they said, hey, this isn't real expense, right? Because it's not cash we're giving out the door.
What did they call it? Did they come up with a term for this adjusted
no, they just
EBITDA
call it
calculation?
adjusted. No, they just call it adjusted EBITDA.
And
That's the joke.
Thank you.
Thank you for getting the joke.
The crime here is that when rates fell to zero and everybody was making money on tech stocks, nobody wanted to rock this boat. And everybody just said, like adjusted EBITDA, kind of ignore it. I can model it into my future dilution. So we model out share count over the course of the next 3 years. But this literally, over the last 5 years, went parabolic. Because I just shared with you the number of employees exploded, the amount of share-based compensation exploded.
Because of competition for those employees, we would assume?
Coinbase, I think, just reported SBC, which... Hold your hat, Sachs, was 70% of revenue. Not 70% of their earnings, 70% of their revenue.
This is for Coinbase we're talking about here?
That's for Coinbase. And so, last week there was something that I thought was pretty brave. Booking.com on their earnings call really called this out. And what they said is, listen, we've been playing by the rules. We understand that stock-based comp is cash. And they say every metric we report includes the impact of stock-based compensation. And if you look over the last 15 years, if I'm an owner of Booking.com, I was only diluted by about 5%. If I was an owner of Salesforce or Expedia, I was diluted by about 25%. That's 25% of my ups were given away. Right. But yet those things were adjusted out when they reported earnings. And so, what's become in vogue today is CFOs get on their calls and they say, no. Don't worry. We're going to buy back a lot of shares. So we won't have much dilution. OK, but if you take my $2 billion of profits that Chamath just talked about and it goes right out the door just to buy back the shares you just issued, you're effectively round tripping that money. Then it just proves the point. It's cash. It's an expense to shareholders. And my biggest problem with it is it's led to the bloat. Because if companies actually had to account for this as cash, right, as opposed to being able to do it, they wouldn't hire as many people. They wouldn't pay as much in stock comp. And I'll end with this because I want to end with the solution. Every comp committee on every board, frankly, their heads spin when you start talking about this subject. They bring in a comp consultant. And the comp consultant is really the CYA for the comp committee. Because they want to approve a comp plan that's been recommended by the management team. And they just want to know, is this what everybody else is doing? Okay? So everybody's doing it. So the comp consultant looks around and says, yeah, all your peers are doing this. This is why Charlie Munger said, I'd rather throw a pit viper down the front of my shirt than hire a comp consultant, right? What is going on these comp committees? If you give bonuses to anybody in your business that is based on an adjusted EBITDA metric rather than free cash flow per share is the key here, it's negligence. It's negligence. So if comp committees just walk in and they say the gold standard as a public company is 50 basis points annual dilution. That's Apple, that's Booking.com, Visa, MasterCard, or even below that. That's the gold standard once you're in the public markets. And we will never incentivize our employees on the basis of anything that excludes stock comp. And it has to be on a per share basis. That would be a massive leap forward for public company accounting.
Seems reasonable.